This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Under the Trump plan, we will have a massive tax cut for businesses and massive tax reform and simplification.
What's in it? What's not? And what might the president's tax proposal mean for you, the taxpayer and investor?
What the markets want. Stocks have been rallying on the prospect of tax reform, so why did they barely budge today?
Moving closer, days before the deadline, is progress being made to avert a government shutdown? Those stories and more tonight on Nightly Business Report for Wednesday, April 26th.
Good evening, everyone, and welcome. What a day it has been. Dramatic tax cuts and fast. That is what the White House called for today. The Trump administration this afternoon unveiled its tax outline, a cornerstone of the president's economic agenda. And at the center of the blueprint is an overhaul to the individual tax system and a very sharp reduction in the tax rates paid by businesses large and small.
As the president said during the campaign, we will lower the business rate to 15%. We will make it a territorial system. We will have a one-time tax on overseas profits, which will bring back trillions of dollars that are offshore to be invested here in the United States to purchase capital and to create jobs.
Here now, more details, such as we know them. For individuals, the current 7 tax brackets would be reduced to 3, with a top tax rate of 35%, down from the current 39.6%. The other brackets, 25 and 10%. The standard deduction would be doubled to $24,000 for joint filing couples. The new plan would eliminate the federal deduction for state and local taxes. This is a big one. And the corporate tax rate would drop to 15% from 35%. U.S. companies would owe little or no tax on their future foreign profits. That's that territoriality Mnuchin was talking about. And the tax rate on business income reported on individual returns would drop to 15%.
John Harwood has been following the story for us all along from Washington. Good to see you, John. There are still a lot of details that we don't know, but broadly speaking, who wins, who loses under this proposal?
Well, you're right, Sue. Because a lot of details are absent, it's hard to make comprehensive calculations, but a couple things we can say. First of all, high-income individuals are going to be big winners because they're going to get a reduction in their rate from 39.6 to 35% if this passes. They're going to get rid of the alternative minimum tax. They're going to have capital gains and dividend taxes lowered to 20%. They're going to get rid of the estate tax. When you talk about losers, Tyler mentioned it a few minutes ago, that is the loss of the state and local tax deduction would hit hard for high-tax, high-income states like California, New York, New Jersey. Those happen to be disproportionately represented by Democrats.
So what happens now, John? What has the reaction been on Capitol Hill? Where do we go from here?
Well, I think the reaction was a little bit underwhelmed because this broadly resembles the plan that Donald Trump unveiled during his campaign. So had this been markedly different, I think you would have had the table turned over, the tax discussion. I think this allows the House Ways and Means Committee, which has been preparing legislation, which isn't terribly different in most respects from the Trump plan. They're planning to do action on a somewhat slower timetable than they talked about earlier. Once they said, well, we'll get it through by August. Now they're saying by the end of the year. And we're waiting for the House Ways and Means Committee to schedule those first hearings.
Yeah. So what are some of the other obstacles? Obviously, getting it all passed is one of them. But what are the others?
Well, the big obstacles politically, Sue, are on the right. You're going to have big concerns about the impact on the debt and deficits. The Committee for a Responsible Federal Budget came out with a back-of-the-envelope estimate this afternoon saying this plan over 10 years would add $5.5 trillion to deficits and debt. That is going to be a problem for conservatives. On the left, you're already hearing reaction from the leadership by Democrats in the House and Senate that this is a giveaway to rich people and they're going to resist it. And it's also true that if you poll the issue of lowering business taxes, that isn't all that popular. And many of those blue-collar, working-class Trump voters may be exposed to a lot of messaging from Democrats who are going to say, hey, your president's going to cut taxes for Wall Street and big business, not for you.
All right, John, thank you very much. John Harwood in Washington. All right, so under President Trump's proposed tax plan, if there are changes to your taxes, which deductions would stay, which could go, and how might it impact you? Bill Smith is managing director at CBiz, MHM National Tax Office, and he's here to share his perspectives on this. Bill, I guess obviously the big change in deductions here, what Mr. Mnuchin said today, is there are basically only two classes of deductions that stay for individual filers, the mortgage tax deduction and for charities. All others go away.
That's absolutely right, Tyler. Your mortgage interest deduction is going to stay, and your charitable deductions will stay, and everything else is gone. And that means some big differences for a lot of filers.
Such as, one of the things that kind of stuck out to me was the medical expenses. On the other hand, there are some people where some of that is covered by employers. Maybe that's not as significant as I think.
I think that won't be that big of a significant change because it's difficult to take advantage of a medical deduction because you only are allowed a deduction for amounts in excess of 10% of your gross income, your adjusted gross income. So it's difficult without some relatively high medical expenses to get a benefit there. The really big one, the biggest one by far, I think, is, as was mentioned, the state income tax deduction.
Yeah,
So,
and that hits, as John pointed out, people in high tax, high income states like California, New York, New Jersey, where real estate taxes are very high. You would have to expect that those congressional delegations are going to put up a fight over it.
I would certainly think so. If you lose your state income tax deduction and your real property tax deduction, that makes up a very large part of the typical Schedule A where people itemize deductions.
You know, what do you think about the aspect of economic growth and paying for it? I mean, there are a lot of things in this plan that, as John just mentioned, people are worried will balloon the deficit and that it'll be difficult to pay for it. As you look at what's staying, what's going, what do you think?
Well, history would teach us that changes in tax policy don't move the economy that much. Of course, the Republicans and the president want to adopt this, a rising tide raises all boats, and this will be such a boon to the economy that the plan will pay for itself. But if history is any teacher, that's going to be difficult to accomplish.
What do we know about deductions I might take for depositing money into an IRA or a similar account, or for the fact that I am paying for 401ks with pre-tax income? And then last but not least, what about those adjustments to income like the effective deductibility of alimony payments for the payer?
Well, alimony is an excellent question, and that wasn't addressed. We did hear from Secretary Mnuchin today that retirement plan tax benefits would be kept. So presumably the IRA deduction would be kept, your 401ks would be safe. It's not clear about alimony, so we have to wait and see as they flesh the plan out and give us a little more detail who's going to get hurt and who's going to get saved.
All right, Bill, we'll find out more in the coming days, I'm sure. Bill Smith with CBiz MHM National Tax Office.
Thanks, Tyler. Thanks, Sue.
As we reported, the White House has proposed slashing not only the tax rate for big companies, but for firms of all sizes. Kate Rogers tells us why that's a big deal for the nation's small business owners.
President Trump's tax proposal includes a key element for small businesses across the country, parity with their corporate counterparts. The major tax cut the White House is proposing of 15% would apply to both big corporations and smaller businesses. According to the Tax Foundation, the vast majority of businesses in America are structured as pass-through entities, including sole proprietorships and partnerships. This means they file taxes at the individual rate because business and individual earnings are combined and can be taxed on the highest end land at 39.6%. Meanwhile, the corporate tax rate is 35%. Small business advocates believe more business investment and creation may follow if the plan is passed into law. Entrepreneurs like Lori Sprouse, owner of destination management company Ultimate Ventures in Dallas, say the current tax code puts her on an uneven playing field with her corporate competitors.
So we have competition sometimes that aren't small pass-through entities like we are. They're getting taxed at the corporate rate, and so for us being taxed at the individual rate, I'm married, and so my spouse may have a really good year, and so we're going to get taxed at the higher rate, even if I wouldn't be there on my own.
While tax reform is certainly welcome among small business owners, not all are confident it will come to fruition. In fact, a recent survey from the nonpartisan National Small Business Association found nearly 1/3 of small business owners believe comprehensive tax reform will never be enacted. For Nightly Business Report, I'm Kate Rogers.
As you probably know, the stock market has been rallying on the expectation of tax cuts, but today the announcement failed to give stocks a lift. The Dow Jones Industrial Average dropped 21 points to 20,975. The Nasdaq fell fractionally, and the S&P 500 was off 1.
So there was the initial reaction to the president's tax proposal. What is next? Mark Lehman is president of JMP Securities, joins us now to discuss. Mark, I guess you could say that it was a case of buy the rumors and sell the news. You could say maybe the market was a little disappointed in what it saw. But what do you think happens next with respect to the market's reaction to the Trump agenda and tax reform specifically?
Yeah, I think your assessment is right, Tyler. I think the market was expecting something like this. I think the rush to get it out before the magical 100 days on Saturday, that happened, and I think this was very much in line with what we heard during the candidate Trump, and now we see it under President Trump. I think there's a lot of devil in the details. Most people have been relatively quiet on the Democratic side. I think there's going to be a lot of work ahead. The reason we haven't had any tax reform of massive note in 30 years is because it's really hard to do, and you got a lot of constituents who have got a lot invested here. And I think there's going to be, the reason the market didn't react is this is very much looking to me like healthcare, which is going to be somewhat drawn out. There's going to be a lot of compromise, and more will be shown of the status quo than actual big legislation. I think we're going to see a lot more of the status quo with some tweaks as opposed to massive legislation.
So it sounds as though you think the odds of it actually passing intact as it is now are relatively low. Is that a correct reading?
I think that's right. I think the odds of this much change and this much of actually a sea change in how we tax people and what those important deductions that have been the bedrock of our tax policy changing, it just, to me, the change is glacial. And this is not a glacial change. This is a huge change. And the odds of this becoming law, like we just saw today, I think are quite remote.
And we really can't tell. Mr. Secretary Mnuchin said today that basically for individuals, the only deductions that survive are mortgage interest and charitables. But he did not go into deductions specifically with respect to business. And that's where businesses have traditionally lowered their taxes. For example, there's been a lot of talk about immediate expensing or the deduction of capital investment and equipment. That wasn't mentioned today. So we really don't know how different businesses or sectors are going to fare, do we?
We don't. What we have is some headline numbers that look very attractive to people. When you see a 15% number for a corporate tax, that sounds attractive. But again, underneath the covers are a lot of specifics we do not know. I think there's a lot of cash held overseas that we've often talked about, that repatriating that cash and taxing it one time, that's a well-versed way to raise some revenue that I think is quite likely. But again, the devil is in the details, and that's why I think the market was very, very quiet today. You had bonds rallying actually a little bit, which I think is also interesting. It kind of stuck at that 230 level. I think this is going to be a long process. And like you said, we thought this was going to be August. Now we're thinking end of the year. This is going to take a long time. It's April now. Let's have a conversation at the end of the summer and see where we're at.
In foggy San Francisco, Mark Lehman, we appreciate it with JMP Securities.
Thank you.
Well, much of the attention today was on the White House tax proposal. Some progress was also made on the funding bill that needs to be passed by Friday, or we risk a shutdown of the government. Kayla Tausche is in Washington tonight. Kayla, good to see you as always. So where do the negotiations stand at this point?
Well, Sue, lawmakers are pursuing both short and long-term options. A long-term option would be that full spending bill that Republicans are still optimistic they can get by the end of the week. Congressman Tom Cole, who sits on the committee that will be tasked with allocating or appropriating the money in the bill, said today that he is hopeful that they will still see a full spending bill. The short-term option could be filed as soon as tonight. That's according to some reports. That could be a one-week stopgap short-term fix to keep the government open so it does not shut down while some of these last-minute fixes are worked out. The White House has been somewhat involved this week, particularly on two matters. Earlier in the week, they backed away from a push to provide funds for the controversial border wall. The president saying he would push that until later this fall so that this bill could go through. Today, White House officials say that they will, at least in the interim, make some payments to insurers that will lower cost of Obamacare premiums, and that had been hotly contested. On that specific point, Senator Chuck Schumer said today, quote, like the withdrawal of money for the wall, this decision brings us closer to a bipartisan agreement to fund the government. So there is progress being made. There is optimism, as there often is in Washington, but the clock is running out.
You know, Kayla, do you get the sense that it's going to play out the way it has in the past, where it's right up to the last minute, which has created an awful lot of market volatility? Or do you get the sense that enough movement is taking place that we may not take it up right to the bottom line?
Well, you never know, Sue. And last week when I was doing some reporting on what the options were, the idea of a one-week short-term fix had been floated. And certain Republicans were saying, well, we wouldn't do that until the very end because that's when you get the pressure. That's when you get the last-minute changes in positions, really when you get up to the deadline and then you have some defections on these bills. So we'll see. They do like it to go up to the very end. It was expected that with Republican control at the White House and at Congress, we wouldn't get this close, but this is where they get some of that pressure.
All right, Kayla, thank you. Kayla Tausche in Washington.
There are reports tonight that the president is considering pulling out unilaterally of the North American Free Trade Agreement. As first reported by Politico, the White House is considering drawing up an executive order that could pull the U.S. out of the pact. The timing of the order unclear right now. On that report, though, the dollar advanced against the Mexican peso and the Canadian loonie.
Still ahead, the stock that suffered its biggest one-day decline ever.
These days, investors are basically focused on two things, taxes and earnings. And today, three big blue chips, Boeing, United Technologies, and Procter & Gamble, reported their quarterly profits, but with mixed results. Dominic Chu has more.
After 2 straight days of big gains for the Dow Jones Industrial Average, stocks calmed down a bit as 3 big Dow component companies reported earnings that were generally mixed. One of the biggest upside performers in the index today, you got industrial conglomerate United Technologies, which makes everything from Otis elevators, Carrier air conditioners, and Pratt & Whitney jet engines. It reported earnings and sales that topped Wall Street estimates, thanks in part to strength in European orders and signs of momentum in the global economy. Sticking with the industrial theme, shares of Boeing were among the biggest drags on the Dow today. The aerospace and defense giant reported better than expected earnings, though sales fell short of analyst expectations. That weakness was due in part to fewer deliveries of commercial aircraft. But on a more positive note, Boeing did boost its full-year profit projections. The stock had been one of the Dow's best performers so far in 2017, up by around 17%. So perhaps a pullback here, not a huge surprise. And speaking of pullbacks, that's what Procter & Gamble stock did today. The consumer products giant responsible for big brands like Tide laundry detergent, Gillette razors, and Pampers diapers also reported mixed results, with profits topping estimates alongside sales that narrowly missed expectations. Procter & Gamble said that geopolitical uncertainty around the world could be affecting market growth and continues to see headwinds in key markets.
It's very geopolitically and geoeconomically volatile, and that's true in this country as well. But take a market like Saudi, for example. It's one of our top 15 markets. The average, the prototypical Saudi consumer has had their income cut by 20%, while energy prices that they pay have increased and are set to double again in July. So that's an example of a very difficult market, and in those markets, as you would expect, it impacts consumption.
When it comes to the Dow, traders will be carefully watching 4 more components that will report this week. Tomorrow, we see results from tech titans Microsoft and Intel, and on Friday, we'll have oil giants ExxonMobil and Chevron. For Nightly Business Report, I'm Dominic Chu.
U.S. Steel has its biggest one-day drop since it went public back in 1991, and that is where we begin tonight's market focus. Last night, the company surprised Wall Street with a large quarterly loss, and the bad news didn't end there. The steelmaker said plans to improve its mills would eat into profits, causing the company to cut its guidance for the full year, and investors today punished shares. U.S. Steel dropping nearly 27% to $22.78. Twitter reported user growth that beat expectations, with the company attributing the gains to improvements made on its basic platform. Twitter also reported earnings sharply above estimates, but did note a drop in revenue. Even so, that also came in ahead of street targets. Shares rose nearly 8% on the session to $15.82. Pepsi reported profit and sales that rose and beat estimates, thanks in part to higher pricing and strong demand for the snack giant's healthier products. Despite the earnings beat, the company said quarterly results would have been stronger if it wasn't for one challenge the company experienced.
Tax refunds for certain payers were delayed until February 15th, and we saw it in our business in the first 6 weeks of the year. As we exited March and now are about to exit April, the business has really bounced back very strongly in the United States. So overall, I think the consumer is optimistic but a bit cautious in the United States, and that's not a big change from where we've been before. If anything, it's probably slightly better.
Still, the company gave weak guidance for the year, and shares fell 83 cents to $113.33.
Anthem said higher premiums and a rise in enrollment helped it post profit and revenue that topped estimates. The health insurer also raised its full-year adjusted earnings outlook and said it would consider leaving state exchanges in 2018 if the government doesn't continue paying subsidies for lower-income members. Shares rose more than 3% to $179.03. Fiat Chrysler reported earnings ahead of expectations as the automaker saw strong demand for its Maserati brand and improving profits in its European market. Overall, revenue also grew, and the company confirmed its guidance for the year. Fiat Chrysler shares popped 10% to $11.65. And Northrop Grumman said an increase in F-35 fighter jet deliveries helped that company post stronger than expected sales. The defense contractor also posted profit ahead of estimates and said it was raising its earnings guidance for 2017. The shares were off 7 cents to $248.06.
Coming up, why the FCC wants to rewrite the rules of the internet again.
ESPN is laying off 100 on-air personalities and writers. The network, easily the biggest in sports broadcasting, has lost more than 10 million subscribers over the past several years, as the cost of broadcasting rights for live events has continued to rise. This is the second round of layoffs at ESPN in less than 2 years. ESPN is owned by Disney.
Well, the rules governing the internet could soon change, and that could impact both the companies that make it run and users like you and me. Julia Borston explains.
FCC Chairman Ajit Pai taking the stage at a Newseum event in Washington, D.C. today to outline his vision for the future of internet regulation and to propose rolling back net neutrality rules enacted under the Obama administration in 2015, particularly a regulation called Title II, which regulates internet service providers as if they are utilities, which Pai says has stifled growth and cost more than $5 billion in investments.
What we don't want is heavy-handed regulation that stands in the way of building next-generation networks.
The fundamental idea of net neutrality is that internet providers should be mandated to treat all traffic on their pipes equally. And the Internet Association, which represents more than 40 top internet companies, including Google, Facebook, and Netflix, says there's no reason to change the current rules. The organization's CEO Michael Beckerman saying, quote, consumers pay for access to the entire internet, free from blocking, throttling, or paid prioritization. And consumer advocacy group Free Press says Pai's proposed change would put consumers at the mercy of phone and cable companies. Internet service providers generally oppose the more stringent regulation of Title II. Comcast issuing a statement saying that it supports the reversal of that part of the regulation, but that it also supports a free and open internet and does not block, throttle, or discriminate against lawful content. Pai saying his proposal will ultimately benefit consumers.
If we want to give more consumers better, faster, cheaper internet, then getting rid of these heavy-handed economic regulations inspired in the Great Depression is the way to do it.
So what's next? Chairman Pai will put his proposal to review those rules up for a vote on May 18th at the FCC's next meeting. That will set off a process of soliciting public comment. Then after 4 to 6 months, incorporating that feedback, Pai would propose a final rule for a vote. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And that does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Matheson. Y'all have a great evening. We'll see you back here tomorrow.